welcome everybody. It's John Michael here with Dart Bank, and I also have a very dear friend on live stream with us today, Ben Hawes from Greenstone. Welcome, Ben. Thanks for being with us here today.
Thanks, John. Thanks for having me.
Absolutely. So today, if you're watching this, you have seen our posts and or been directed here by a builder, a friend, family member, somebody to talk about barndominiums. Feels like the hottest craze that we've seen in years. You started a few years ago. Somebody called me up for barndominium financing and be like, barndominium, what the heck is that? And then I ended up building kind of my own version of a barn dome myself personally in 2018. So I will tell you, I've actually walked in some of your shoes. Not totally, because we don't live in it. We kind of use it as a little rec center for our family. But many of the same elements and very familiar. And I'm very familiar with financing barn domes because we've got a lot of clients who've been through it, as is Ben. So Ben, when we first met, talked about the fact that Greenstone actually also specializes in barndominiums. And the nice thing for everybody that's on this live stream today is going to be that both Ben and I have programs and products that complement and do different areas of financing. What I can't do, Ben can do. There's some things Ben can't do that I can do. And so that is a huge benefit to you. The other thing is, if you're on here, you're already working with a lender. Obviously we want to protect your relationships, have you feel comfortable. But what it will do is raise some questions to make sure you're asking things up front that make sense, and double check to make sure from a financial standpoint that that this is in your best interest too, because ultimately you are paying interest on that mortgage and you want it to be something that benefits you and your family. So, but let's jump into the barn dome stuff. Hey, Ben, before I start going through kind of a list, what I did, everybody, by the way, is I've been doing this for 30 years, and I have a pretty sound understanding that almost all my clients will go through one of 12 categories. Okay. So they're going to get into, when they come to me to talk about construction financing, regardless of what, they're going to hit me with, one of these things that are going to be on a list that I can go through with you today. And Ben, we really haven't chatted. So this is you're going to see this kind of informal. So Ben and I are just going to be throwing some stuff out there. Ben has some things too. He may even add to my list, okay? But we'll let Ben throw on there. But if there's something you guys have, if there's a chat that comes up, we've got somebody monitoring. If you've got questions, bring it up. Hopefully if it's in chat, you feel free to ask questions in chat and or posting, and we've got somebody monitoring that will let us know, and we'll try to get your answers while we're live. And if not, you can post them. We will most definitely look at that afterwards to follow up. But Ben, do you have anything you want to add before we jump into this?
I just wanted to add that I've been in the lending industry now for 2 years, so I'm relatively new, but I do have an open mindset as far as what people are looking for in the market now. And barn domes are one of the most popular options as far as new home financing goes. Living in the rural country, I see a lot of them to and from my way to work, and have gotten numerous requests for them as well. And John, as you know, the demand for new homes is high, but the supply is low, especially for houses. So that's why we're getting a lot of construction inquiries. Yep. A lot of people don't understand that. They think it's similar to what happened back in 08 or 09, and that's not at all what's happening. It's actually a supply and demand thing. So we suspect that construction loan inquiries are going to still come forward, even with higher interest rates. So that's why we want to be here today to answer questions and help you folks attack it in the most efficient way. So
yeah, that's awesome. Yep. Great point. Yep. And if you want to, I even have on our website, if you go to michaelamortgage.com, there's actually a video we did about 2 weeks ago for exactly what Ben's talking about, where I actually bring you all the data points to show you exactly what Ben just supported. We do have a supply demand issue going on. There's actually 5 elements that are taking place in our United States housing market right now that will support home prices. Not to say that you won't see bubbles or pockets where there could be declines, but you're not going to see that 2008 price crash that we had before, all of them what Ben was talking about, and there's data to back it up. So feel free to jump on there. You can look at that, another time at your convenience, just, all data points. So with that said, let's jump in. I'm not seeing any questions yet. Again, feel free at any time, you guys, you got questions, chat, throw it out there. So the first thing I am going to talk about is lumber prices. Hey, listen, so Ben and I, obviously, we cannot control lumber prices or building costs. That is something that is going to, continue to float, be variable, especially when we get into turbulent economic conditions. But here's the one thing I will tell you. I built my house in 1996 and I built for about $100 a square foot. That's not going to happen anymore. So, right. So the one thing I look at when I'm looking at a package for someone, when it comes to lumber prices, there may be some short-term things, or even your subcontractor costs that Ben and I cannot control. And so we have to look at it as a relativity standpoint for you. In other words, hey, if you're building this house and you think you're going to turn around and try to sell it in 2 or 3 years because you're transient in your job, maybe you're kind of in a step up community, you want to be somewhere else. You really want to be thinking, is this the best thing for you? It may not be, okay, because prices have escalated and you could see a drop in resources if we get into a deep recession. So I don't know how, Ben, if you feel, but I already feel that we're in a recession. GDP numbers came out yesterday. That to me is a trigger, that even now, technically, we are now in a recession because you've got 2 consecutive quarters. But, we are in a recessionary environment, to my belief. And you could see lumber prices drop a little bit, but I wouldn't look at making a decision over variables that neither you nor Ben nor I can control. So we look at relativity. Ben, do you want to address anything you can think about, building costs and what you see?
I think you nailed it on the head there. Thinking about building costs, I guess I may take this just a slightly different route, but I think it does relate. John and I are familiar with looking at sworn statements. We analyze them, we read them. And one of the biggest things that we see when you present a sworn statement to us, whether it be a contracted or a do-it-yourself construction loan where the customer acts as the general contractor, it corresponds with cost, is that labor is not being added to specific line items. And John, does Dart Bank, you guys do DIYs as well, right?
We do not. So we're going to talk about that. I actually just made that a second. I'm going to bring that up because you're giving us a segue. So let's talk about acting as your own general contractor next.
Yeah. So I'll save that for just a second. But to go back to your other question, as far as prices go, obviously gas prices are going down a bit, so that should affect the other resources that go into building. However, interest rates are climbing up as well, so that's one thing to be cognizant of. Adversely to that, there's things that we have as far as tools that I can speak intelligently on, as well as I'm sure John does as well, that we can combat that with. If you're still dead set on building your home, we absolutely have solutions. But we're financial advisors, or not financial advisors, financial service officers as well. So we can advise you the best way to approach new construction.
Yep. So let's go ahead and use that as a segue, though, Ben, to talk a little bit about self builds and hiring a general contractor. So at Dart Bank, we do require a licensed general contractor to oversee the entire project. So I will get some people that ask me like, hey, can I have 2, 3, 4 licensed general contractors? And I have to say, no, I'm sorry, you can't, because then you're still acting as a general over the generals. So we do require a licensed contractor. We can delve into that a little deeper if we see some chats or questions come up. But that is something where if you call up and you say, John, I'm doing this all myself. By the way, I did that myself, so I get it. I understand the value. I also do know, now that I'm older and more experienced and been down that road, I also know the drawbacks for it and the reasons why banks don't lend on it because of the risks. So I'm going to transfer this kind of more over to Ben to answer these questions, because he's going to bring out some risk factors that Greenstone is, they're aware of, and that they're going to require for you if you are being in general. So Ben, do you want to address that for any of the folks that may be thinking about building it themselves?
Yeah. And if I kind of get going on different avenues here, just direct me back, maybe ask me a question. But
Sure.
There are 2 different ways to approach it. Number one is with a general contractor, like John said before, has to be licensed. What Greenstone allows for is do-it-yourself construction, commonly referred to as DIY. So the borrower gets to act as the general contractor, meaning that you do not have to have any licensing. But what you do need to understand is you need to be proficient in filling out a sworn statement, obtaining lien waivers, collecting all bids and estimates. You're acting as the general contractor, so there's going to be a lot of responsibility on your shoulders. You're going to have organization, access to things such as Microsoft Excel, because we do require sworn statements to be filled out in Excel format for obvious reasons, such as the quick calculations it offers, as well as keeping you organized throughout the construction project. DIYs are great in the sense that it does save you money from having to pay that contractor. Adversely to that, I think sometimes it can take away from the experience for the borrowers as to, they have to have all that burden of facilitating the sworn statement, tracking down lien waivers, and making sure that they're monitoring the project as it goes along. Whereas these generals, they do this for a living. There's a reason why they get paid to do what they do. And it is a very added benefit. But if there's somebody who is knowledgeable enough and they know about the general contracting, maybe they have a brother, an in-law, or a close friend, that'd be an option to where they could bring them in as a trusted advisor, essentially. So it'd still be a DIY, do-it-yourself construction. So there's different ways to approach it. I don't know if that kind of
let me throw in some additional questions. I think that maybe get you a little further into the weeds. Okay. So one of the things that I talk about when people come to me for, being their own general, and because I still want to have discussions and try to be a guide for people, one big thing is, what happens if you have, budgeted very lightly on labor because you're going to paint or maybe do interior trim or even maybe the framing or roofing, some folks want to do it all. But let's say there's specific line items. And I say to them, what happens if you get, hit by a bus? What if you fall off the roof? Now, all of a sudden, your project's at risk because you're sick, you're out of work, you can't get these things done, or you hired Uncle Joe to do it. Uncle Joe's got his full-time job or a gig he's doing. So I say, from a pragmatic standpoint, are you budgeting in a labor item so that you have what we in the banking world call contingency reserves to help cushion that in the event something goes south and you need that? So my question then, Ben, from a banker to banker, but to our general public in layman's terms, do you make folks go out and factor something in? In other words, do you require a contingency reserve on your self-builds?
Here's how we're proactive with that. We tell our borrowers, if you're going to be doing a do-it-yourself construction loan, meaning that you're facilitating the sworn statement, and you plan on doing the labor, whether you're doing some or all of it, you have to go and fully get bids and estimates for every line item in that sworn statement as if you were not doing any of the labor, for the reason John alluded to previously. What happens if you get hurt? What happens if you're not able to do it? What happens if you simply don't want to do it and you want to contract it out? So you have to bid it out as if you were not doing it. So essentially, you got to qualify for a much higher loan amount on the front end. On the back end, you do labor throughout the construction. You're not going to be drawing as much from every time you request a draw. Let me just give you a quick example. You have flooring allocated, laying wood flooring down, and maybe you're utilizing Lowe's for the materials. It's $20,000 for the flooring, $10,000 for the labor. So you have $30,000 allocated to that line. When it comes time to take a draw and you've done the labor, you're only going to disperse $20,000 from the loan. At the end, when the loan has been fully dispersed, we'll do a one-time reamortization. So you earn equity as you go throughout the loan. And that is the biggest issue we see with DIY construction, is when we get that sworn statement, we see what the total cost to build is. We divide it amongst the livable square footage, and we're looking at it, and we have a super low cost per square foot to build. We know right then and there, we want to see the bids and estimates to see if labor was added back into it. And maybe sometimes it is, but it's too low, because we see these all the time. Our credit department analyzes them as well as I do. To add on to that, we do require a 10% contingency over the total cost of build. And that is for overruns during construction. So that's how we kind of mitigate that risk a little bit, during construction. And then we mitigate the risk up front by making sure the borrower obtains all bids and estimates. And then we take a deep dive into it too, to make sure that labor is accurately accounted for as best we can.
Perfect. So folks, just, again, from an interpreter standpoint, I think Ben did a really good job at keeping it baseline in layman's terms without banker jargon. But just as to kind of do a little quick summary. So what Ben's saying is if you're going to do this yourself, you've got to still go out, get those bids, put them together. And then on top of it, he's going to add an additional 10% to give the bank a little safety net, as well as yourself, for you. So what we're going to talk about, I got one more question for Ben, but then that's going to we're teeing it up perfectly, Ben. Yeah. It's almost like we're scripted. They would think this was actually rehearsed, but the next thing on my list is actual affordability. So you've got to remember that if you say, hey, Ben, I think I can build this house for X, you may be able to do that. And you could show them, like, hey, look, I proved to you. And then when the job is done, but what you're going to have to get a mortgage for and then qualify for from an affordability standpoint is that higher number with bids built in plus your 10%. So keep that in mind. Okay. So that way you're not calling Ben and, hooting and hollering at him because you've got to get a higher mortgage. You know from right now going into it what their expectations are. One more question on self-build, Ben, and then we'll move on to more issues. A lot of times I also see with self-builds, the issue is that a homeowner has got their land paid for, their down payment's gone in up front because of meeting our bank loan to value requirements. Now all of a sudden they don't have a lot of cash sitting in their hand, and they need money to pay maybe a supplier up front or a subcontractor up front, or to put deposits on windows. I got a deal right now. We had to cut a big check at closing for windows. So we're advancing some money out in front of a project being completed. How does that work for self-builds with you guys? Because I know that a lot of self-build people, they need access to those funds immediately. And traditionally, the way a bank works is a builder will do their work, they'll do an inspection, make sure work's done, then they'll get a check. So how does Greenstone handle that with self-builds?
So with self-builds, the earliest you can request a draw would be at closing. We're not going to advance any funds prior to closing. At closing is the earliest you can request a draw. So if you request a draw at closing, we could disperse those funds on that day. And then when you need the next draw, you'll be supplying lien waivers and paid receipts for the previous draw. So you're always working one draw behind. And we have 4 inspections throughout construction. So it's not like every time we disperse funds, we're going to go out there and inspect and see where those funds went to and what labor was completed. There's 4 inspections that are timely. And I can provide that information to customers who inquire, just the general populace that's following today. But generally, they're after the footers have been poured, and then you have one at rough end, one when the interior is complete, and then the last one is when the township issues the certificate of occupancy. We'll do our final inspection. But again, we do not advance any funds up front. And one thing to keep in mind too, for the borrowers out there, a lot of times, 20% down is pretty hefty along with your closing fees. However, the funds that you put down at closing is what's going to be used first in construction. That's one thing to keep in mind. And then I did want to make one point, John, real quick, if I could.
Yeah.
With that 10% contingency, and like I said, you got to qualify for a higher loan amount up front. And what I mean by that is, let's just say that once you add in the 10% contingency, you've gone out and fully bidded everything, and your total cost to build is $400,000. But in your mind, you're going to do all the labor. You don't think you're going to have to use any of the contingency funds, and you think you can build the home for $300,000. That's great, and I hope you do. But you got to qualify from an affordability standpoint previous at the $400,000. Even though we may end up finishing at the end with $300,000, then that's your mortgage amount because we do a one-time close. So I just wanted to throw that out there.
Perfect. Hey, Ben, so we do have a question, and this is a great question, actually, and I'm sure some people are thinking of this. So I've got a little note here that I want to come back to on affordability. And then so just really quick before Adam asked a question, and I'm going to go to that in a second, on the disbursement of funds. So just to reiterate, with Greenstone, if you are self-building, it does appear that, Ben, and just correct me, you can advance funds. So if you're at closing and they need to get that, let's say a lumber package ordered, you can go to closing and disperse. Maybe that disbursement may be some of their own funds, but if they come short, you're gonna buckle up that other part of it. So let's just say a lumber package is $80,000. They've got a $40,000 down payment. They cut a check for 40 at closing. You're gonna make up that 40, even though the lumber hasn't hit the site. You guys are able to do that.
Yep. And then before they request their next draw, we'll just need that lien waiver, whether it's a partial or a full, before we're going to disperse any more funds.
Okay. So folks, that's a big deal. Okay. That's a real big deal if you're a self-contractor, because, if you need access to that money, there's not a lot of lenders out there in the country that will do that. So make sure that, if you're in that spot, you want to talk to Ben about the details. So that's a big deal for you. Okay. So let's go to Adam's question. So Adam's question is, what happens with the leftover money at the end if there is some? Do you have to take and make payments on it, or is it removed from the loan? is and lower the overall price and payment. So at the end of construction, everything's wrapped up, and they had, let's talk about. Well, I can answer mine after you. Let's assume it's a self build for Adam, and he had these contingency reserves, that extra money in there, and he's got he saved himself 50 grand at the end.
Yep.
Tell Adam what happens to his money.
So you can either use it for more property improvements, specifically relating to our collateral. If you're going to be improving that property in any way, we can allow those funds to be utilized for that purpose. Ultimately, it has to be approved by our credit department. But if you're going to be utilizing it for property improvements, we can allow you to do that. Say at the end, you've got $50,000 left over, and you wanted to throw on, a small storage shed, or maybe pave your driveway, something like that. That'd be something we could approve it for. Or if you simply don't want to use it, then your loan amount is lowered, and then we'll do that. We'll reamortize it over the term that you agreed to in the interest rate at closing, and thus lowering your mortgage payment. So
yeah,
those are the two options.
So Adam, if that didn't answer your question, make sure you reply back in. But just to summarize, so in that case, if you had that extra 50 grand, it's going to go back on your mortgage. And if he had, if we had a payment projected, let's just say of $1,000, and that lower $50,000 drops it down to $750, then your end mortgage for the whatever you're at, 20, 30-year mortgage, is at that lower $750 payment. Okay, if that doesn't make sense, or you feel uncomfortable and need more clarification, shoot up a chat. And before we keep going, and again, you guys, this is for you guys, so I'm going to try to keep a structure for us. We won't stay on here forever. we'll probably limit it to about an hour. But we bring your questions, and we will go to your questions first versus the other stuff. So we've got another question from Ashley. She says, "Hey guys, thanks for doing this. You're absolutely welcome. We love being servants to our clients. What are the criteria for financing, credit scores needed, and so on? As much information as you can provide in an umbrella statement." Wow, that's a big one, Ashley. That's huge. Let me go to Ben first, and then I'll step in after Ben.
Yeah, I'll keep it simple for the sake of, because as John alluded to, it can get pretty complex, and a lot of things won't make sense unless we can give you a visual aid. But as far as credit scores go, Greenstone generally requires a 680 minimum credit score. You have to have $1,000 residual monthly income, 40% debt to income ratio cap, and then 2 times your post-close liquid asset reserves. So those are the basics. That's what most of our customers fall into as far as an underwriting matrix. That's what we call our normal column, and those numbers I just listed there are for normal. If I could just simply explain, your debt to income ratio is simply your monthly income compared to your monthly debts. It's a simple division problem. And then your 2 times your post-close liquid reserves. What that is, we will pull your credit. We'll also include the new mortgage payment you'll have for the construction loan. And so with all those things combined, including property tax and insurance, you'll have a total monthly obligation. Okay, that'll equate to a number. Let's say it's $2,000. You will need to have, after we've deducted your 20% down plus your closing costs, you'll have to have what's called post-close liquid reserves, and those are composed of your checking, savings, retirement, investment accounts. So once we've deducted the 20% down in closing costs, you need to have 2 times your total monthly obligations in post-close liquids. I know that gets very wordy, but that's the best way I can explain it in a nutshell.
So I'm going to try to clarify. I'm trying to look at it from our viewer standpoint, Ben.
Yeah.
Just to take some of the banker language out. So let's stay with that last one, the reserves. Are you talking about 2 times PITI, or are you talking about 2 times like all debt, like credit cards, car payments, and projected monthly payment for the house?
Yeah, so PITI and all debt. So, and then we categorize that as a total monthly obligation.
Okay. So guys, so viewers, I'm just going to give you some numbers, try to make it a little clearer, Ashley. So if, like Ben's saying, if your housing payment is projected with taxes and insurance, everything when you're done is $2,000. You got a car payment for $500, and then you've got maybe some Visa and MasterCards for another, let's say $500. So total everything is $3,000. Take $3,000 times 2. That's $6,000. After you go to your closing with down payment, your closing cost, everything you need for your closing, you also have to have $6,000 sitting somewhere, okay, that you can access. Can't be under your mattress, okay? Correct. Can't be gold hiding in the backyard. It's got to be in a liquid checking savings,
Verifiable statement.
Can you use 401ks, Ben?
Yes. Yep. Absolutely. 401ks, 403bs.
Okay.
Your Edward Jones accounts, those IRAs, everything.
Okay. Perfect. Awesome. One more thing, $1,000 monthly residual. That's a big term for people. Can you clarify that just a little bit more, what that means for them?
Yeah. So you take your monthly income and then you subtract your monthly debts, and that's generally what your residual monthly income is. However, when you look at it from a financial institution, and what we do on our side, there's some algorithm in the back scenes that takes into account for your general living expenses that will not appear as a debt on your credit bureau, such as gas, food, entertainment, things like that. Not necessarily entertainment. Let me back up, but gas and food, things that you need to be able to live, to be able to work. So we take that into account as well. So it's not as simple as I make $4,000 a month, I have $2,000 a month in debts. Is my RMI $2,000? Not with our calculation. It's a little bit more complex than that. And when we run the numbers, we can tell you what your RMI is, and if you meet that threshold of 1,000 minimum.
Perfect. Yeah. So guys, what I'd probably tell you is if you're talking to Ben or Greenstone, have him run those numbers, because that can get a little tricky and complex. So
Yeah.
I'm going to transition real quick so we can keep things moving on my side. I'm going to tell you that the guidelines that Ben put out for you, I'm going to be a little different. Like, I don't necessarily have a minimum credit scores till we get down in the low sixes. I've got a guy right now that we just approved at 640 this week. We do not have a residual basis to have to calculate. Reserves are dependent on kind of the loan structure itself. There are times when we don't require any reserves. If we start getting up into some of our jumbo programs where you're looking, let's say, at a $800,000 loan amount, we typically will request 6 months worth of reserves for that. And our debt to income ratio is, again, kind of flexible. We try to target 43%, but I have had people that we've closed on at 49.9. 50% is probably our hard stop. And even when you get over 43, depending on credit scores and the overall risk factor, that can kind of take things out. So the back end ratio 43%. We like to see some job history with things as far as qualifying, but overall we got some flexibility. It kind of looks at some things from an overall perspective. Okay,
John, I did want to touch on as well that those numbers that I threw out, that's our normal column that most customers fall into.
Yep.
However, I don't want to discourage anybody from applying. If you have like a 665 credit score, we may be able to get you approved still. Nice. I just would have to look at it, because a credit score doesn't define you as a customer. And I don't want to discourage anybody from applying, because we can go all the way up to a maximum 50% debt to income ratio as well. But all those other criterias, they get stricter as you go up, as well as the amortization term that we can do at Greenstone. It shrinks a little bit. Or if you want to keep the max amortization term, then you can't go as you have to put more money down, such as 35% down, which equates to, John, 65% loan to value. It makes it a lot more difficult.
Yeah. So guys, just again, banks a lot of times look at things from what they call layered risk. And that means that Ben could be looking at something. And so, like I was saying, like, hey, with me, you're going to come, I'm going to look at your big picture. Ben will do the same thing for you. Like he's saying, well, 680, but maybe 665. Let's say you're coming in there and you had some medical collections and it just wasn't your fault and just stuff popped up and there it is, right? But you're putting 50% down and you've got, 20 years on the job and, great cash reserves. Ben's probably going to look at that loan and go, yeah, we want to help these folks. So don't, like he said, do not get discouraged from calling either one of us to talk about your situation. We want to guide you through it and, help kind of point you down the path. All right. So, hey, we were getting more questions, Ben, so I'm going to keep things moving. There is a question from Tom. Tom asked, this is going back to the contingency rule, says, can you roll over the 50K into a new investment property? Tom, I'm going to jump in probably right away. Ben can correct me on this, but I'm probably saying no, you can't do that, because that money is going to be allocated back as a modification towards your lower balance. So you guys, you cannot get cash back. Even when I'm doing something for you and we, tap out, even if your builder comes in at a lower cost, or you put money down during the process of building so that your actual construction balance is left, or when Ben has a contingency reserve, any of those things, when we go to modify you guys, those funds have to be placed down on the mortgage. They cannot come back to you as cash. And that was, Tom, that's basically what we'd be doing, is giving it back to you as cash to go put a down payment or buy something. So Ben, unless you have any other comments about that?
Yeah, ours would be the same. Like I said before, property improvements are acceptable. Otherwise, you just don't mortgage that amount, so it lowers your mortgage payment.
Perfect. Okay, we got a question from Stacy. Stacy says, "Does the land need to be purchased outside of construction?" So, Ben, you want
For
to
us,
answer that
no.
first?
Yeah, for us, no. We can tie it into to one mortgage, and so we can absolutely do that.
Perfect.
One thing you want to communicate, though, if you're working with the seller and purchasing the property, is that the process could take a little bit longer. So you're going to want to be communicating with them. It's contingent upon you getting approval, things of that nature. But we can absolutely wrap it into one.
Yep. Yep. And I'm going to mimic Ben there. Same thing with us. We actually kind of treat, when we do a construction loan, we kind of categorize them between, if you need to buy the land while you're doing construction, we kind of treat that like a purchase. And if you own the land already, we kind of treat it like a refinance. So
Yep.
for us, we look at it as two separate guidelines. Matter of fact, why don't we just talk about that for a second, Ben? So when we do our construction loans, if somebody already owns their land, so let's say they, got it from family a few years ago, or they've been sitting on it waiting for the right time. Now they're ready to go build that dream house. What we do for appraisal values is we actually treat your value that you're going into it as your appraisal. So there's other calculations called acquisition costs, which we do on a purchase, but we do not do that when it's owned, when you already own your land. So it's just a plain simple calculation. Hey, if that house appraises for X, that's what we're using, and that your anything underneath your borrowing, that's your gap for your equity or your down payment. So Ben, how do you guys look at that?
So we have a policy. So with land, if you've owned the property for greater than 12 months, we can allow for the appraised value to be considered for that land. However, it's in combination with the land and one of two options. It's either your total cost to build or the AV, whichever is the lesser of the two, is what we base our financing off of. So appraised value versus total cost to build are the two different aspects you're looking at. Either way, the value of the land will be considered in that. If you've owned the property for over 12 months, we can utilize the appraised value, thus a lot of times giving you more equity, especially if you owe nothing on it. If you've owned it for less than 12 months, maybe you're buying it with this new construction, we can only utilize the purchase price, even though it may be worth a lot more. The only exception to that is if you're gifted the property, okay? If you're gifted it from family. So that's the way we approach it. Just because you paid $50,000 for property last year and you owe nothing on it now, equity floats, right? It's a variable. And another thing to consider when that appraisal is conducted, vacant land, as opposed to when you put a home on it, appraises a lot differently.
Yeah.
It does depreciate that land value when you put a home on it. It's not looked at the same as it is vacant.
Yeah, that's a great point, you guys. So what Ben's saying is, think of it this way, okay? Because I do get people say, hey, do you do an appraisal on the land? Do you get appraisal on the build? That's not how the appraisers do it. Basically, the way the appraisers are looking at this is when you're finished with construction, everything's done. You turn in the keys, you're moving in, you're going to stay the first night in your house, cook breakfast in the morning, okay? When you do that, if a real estate agent was to come by and stick a sign in your yard and tell you, hey, your house is going to now sell for this, that's what that appraiser is basing their values on for both Ben and I at the time of application or beginning construction. So they're projecting forward out there saying, hey, when your house is completed, that's why the appraisers are called subject to completion. When your house is completed in today's terms, so right now with the data that's available to them, we're going to say that your house is worth X when it is finished. Okay. So hopefully that makes sense to everybody. That's how the value is calculated, and why Ben's saying, don't expect, if your land is a beautiful piece of property and, if you're out there shopping and it would cost, $200,000 to buy, don't look at it as that's just automatically $200,000 going in your project, because it's considered because your house is being built on a beautiful piece of property, but they are looking at the finished total project, not in sections. Okay, hopefully that makes sense to everybody. So
yeah, and last thing on appraisals, they're not replacement costs. Appraisals are not replacement costs. They're opinion of value based upon comparables and recent sales. Additionally to that, with pole barn homes, that can sometimes be a challenge finding comparables specifically on pole barn homes that are on less than 10 acres. There's not as many comparables, whereas there are more so on acreages above 10 acres. That's just one thing to keep in mind. Specifically at Greenstone, if we need to have at least one comparable sale, and those can be difficult sometimes on less than 10 acres. It just depends on the area you're in. So just keeping that in mind.
Yep. Actually, Ben, man, you're teeing this up. Appraisals are on there. Okay, but we're going to segue for a second. We're going to come back to appraisals because honestly, when we're talking about this stuff, you guys, a lot of the things we're referring to is construction, regardless of your barn door or not. Okay, specifically, this live stream is for everybody out there that fell in love with their barn door and they want to. I'm just going to make a quick comment here as we're going through this. Barndominium financing really isn't that hard. Okay, it's not. So the lenders that are out there, because I'm watching the live streams and the posts and hearing stuff out on the marketplaces, and I see a lot of stuff. Oh, this bank only does barn doors. Guys, barndominiums are not that big of a deal. They really are not. Okay, the biggest issue for your barn door is your appraisal. And we're going to come back to that because I think we want to deep dive and talk a little bit about the appraisals because that can vary what Ben's saying. I do have a question. Crystal is bringing up, she is asking, let's say I already have the land. Can I do a construction loan on the pad, the shell of the structure, plumbing, electrical, walls, frame? Is there a loan option for that, or does it have to be from start to finish? So, Crystal, I'm going to tell you, for me, it's got to be full package. We can't do a halvesy. Okay, it's got to be a turnkey project. That's why we're asking licensed contractors to come in there. They're going to start from beginning to finish. So that's my answer, kind of pretty black and white. There's not a lot of options. There's some options you can get into creatively, but really that's like taking home equity loans out against your current property or possibly a bridge loan and then using that cash to finance it, but it's not like a separate mortgage. So if you came to me with something like that and you had a ton of equity in your house, but I'd probably talk to you to say, hey, can we look at doing a bridge on your current place that'll transition you into something that would maybe get you, and I got to be a little careful, probably be a home equity loan that would get you that versus a bridge. Bridge would put you into construction. But Ben, your thoughts? You got anything that would help Crystal?
Did she say she owns the land already?
Yes, she already has the land paid for. Yep.
Okay. So if she owns the land already, one option that Greenstone could do would be a cash out refinance. Simply, we can go up to
on the land,
yeah,
right?
On the land. Yep. So 80% of the value of the land, we would not take any of those improvements that you're doing as value, because if we did, we'd have to do full construction procedures, and the only way to do it would be a construction loan. But if we did it as an as-is appraisal, meaning that we take the land as it is with the improvements that are there currently, we could go up to 80% loan to value and give you the cash out for those property improvements. We could look at doing that. That'd be about the only option around it. So there is an option.
So Crystal, if you had a big, if you've got a big, beautiful piece of property, 30, 40 acres, that's gorgeous, worth a lot of money, and is going to appraise well, let's say it appraises for $400,000, and you said 80%, Ben?
80% loan to value, max cash, or max value on vacant land.
Okay, is there a loan? Is there a limit on the loan amount? Because that would get Crystal $320,000 if the appraisal came in at $400,000.
Correct.
Okay.
Yes. So the max, I'll just say the max term you can do is 30 years on that vacant land.
Yep.
As far as minimum loan amount, generally 20,000. And then as far as acreage requirements go, for cash out on vacant land, generally 10 acres and above is the easiest way to get it financed.
There you go, guys. So there's your guidelines for what Ben just. So Crystal, there is a potential option through Ben to do something like that if all the factors worked out. If you had enough equity in your land and that, so or maybe you get you a chunk. Okay.
Mm-hmm.
All right. So I think we've got questions up to this point. So you know what? This is a big one. We were transitioning to appraisal. I actually had appraisal at the end of this. But we already hit on it, and we're 11:25. I'm going to try to keep this to an hour, you guys. So let's just talk about appraisals, because I think appraisal is probably the part that drives lenders away from doing barndominiums and has put everybody in the spot where like, oh, it's so hard to get barndominium financing. Well, again, in my world, really, it's not. Okay. What Ben's saying, with one comp, we'd like to see. I'd like to see a couple more. We have to use 3, but definitely you want to have at least one comp out there to show that the market's going to support that type of construction in your area. So in rural areas, maybe we get way up north or way far out, That's where barndominiums end up being challenges, just because those appraisers do have to find the comps. Now the good part is, like, so our footprint here, Ben, you're in, where's your office at again? I can't remember from our different locations.
So I'm in Jackson County off of M60. M60
Yep.
runs parallel to 94.
Okay.
And so in between Jackson is the major, Jackson and Albion.
Yep. And so guys, I'll go all over the state of Michigan, so I'll go all over, but like, I'm just going to talk like in my circumference. I know my market really well. So like Jackson, Washtenaw, Livingston, Lenawee, Ingham County, we've got barndos. There's barndos. I mean, I've financed, so like I've seen them. I know they're there. So I know that if you're in that circle, okay. But if you're calling me from, way up in the UP, I'm not going to know your market over the phone, and I'm going to have to rely upon maybe you or a realtor or builder, or reaching out to some appraisers up there, just to kind of get a gauge of the market, to even have some idea up front. But appraisals, that's your big thing, and so don't be afraid of them. It's not really that big of a deal. The agencies, Fannie Mae and Freddie Mac, actually came out with guidelines that now say this is not an uncommon piece of property anymore. So even agency financing, where I get my best rates from, have said that this is now becoming a common structure, and have given direction. So as far as anything on the appraisals else that you can think of, Ben, for that you want to make a comment on?
Not on the appraisals, but as far as the market area, where your market's at. I specifically deal with Jackson and Calhoun County primarily, which is why we have multiple greenstone offices spread out through the state of Michigan and the Northeast Wisconsin. So I'm pretty limited to Jackson and Calhoun. However, if I do have referral sources and somebody's from, the Eaton County or maybe Kalamazoo County, I can definitely write those loans. But we do have regional boundaries as loan officers. So I specifically deal with Jackson and Calhoun. However, I'll answer any of your questions that you have and get you in the right hands. So I just wanted to make a point of that for the customers that are viewing.
So if you had somebody, let's say from Traverse City area, you could connect them with somebody up in that market. Okay, perfect. All right. So guys, when it comes to appraisals, the next thing I want to talk a little bit about is the down payment. That's kind of where we're transitioned to. Believe it or not, that was number 3, and I've got 12. So, but we're covering a lot of ground. And again, this is for you guys. So if you have questions, keep posting, and we'll keep throwing those out there. But down payment is another real big one. Just got off a call this morning with one, and the poor customer is saying, "Hey, man, everybody's telling me I got to have 20, or at the minimum right now 15% down." So at Dart Bank, we work off of, you see it, 5% down. So 5% down is where we will we'll start with. There will be some variations of that depending on, again, your factors. If we're looking, kind of going back to what we talked about earlier for qualifying criteria, credit scores, risk factors inherent in the loan. Get up into some of my bigger mortgages, we really want to be at 10% down. So that's getting back into those jumbos. But 5 to 10% down is where we're going to be at for our down payment. Ben, how about you? Where are you at?
We generally start at 20% down. We can go up to 15% down, but at 15% down, you're looking at a max amortization term of 20 years. And then anything lower than 15% down, up to 5%, would be requiring private mortgage insurance. So you're going to have that interest rate add-on. It's where PMI takes on that additional risk and coverage, and that would be contingent upon them approving it as well. So
if at 5% down, are they at a 20-year AM? 20-year
they can go up to 30-year AM on 5%.
Okay.
Just 15 is limited to a 20. So
okay.
15% down is limited to a 20-year term.
Okay. What if they want to do 10% down? That
would require PMI as well.
Okay. All right. Perfect. All right. So that kind of gives you, again, the myth that's out there that to build a barndo, you got to have 20 or 25% down. Not true, guys. You're talking to both seasoned lenders. They're telling you if if all the right factors are in place, there's 5% down financing available for your barndo.
Yep.
Okay. Yep. All right. Next one, let's talk about land. So we've already kind of covered a little bit about some elements if you've already owned it or not. But if you are going out looking for land, I generally tell you just to start with a real estate agent. If you've got connections and stuff, that's fantastic. Approaching neighbors, any way you can do it, doesn't matter. We can certainly finance your land into your project, as we've already talked about. Ben has as well. But let's talk about the land specifically. Ben, do you have any restrictions on land, whether acreage size, location, zoning, anything like that?
Yeah, so this is obvious to me, but it's not probably to customers because they're not maybe as familiar with Greenstone. But it cannot be within the city limits. If it's within a township or not township, within a village, the populace cannot exceed 2,000 people. So those are really our two biggest limitations. Outside of that, as long as you're in the rural countryside, there's really no acreage limitation. But I will say, if you're there's, and I'm going to get a little bit wordy here, John, so forgive me, but we have three customer segments at Greenstone. The ones I deal primarily with are part-time farmers and rural resident customers. The difference between the two is part-time farmers own 10 acres or more, or they generate $500 of agricultural income or more annually. That wouldn't necessarily have to be reported, just communicated. So if you're in the part-time farm category, you're not limited to the maximum structure that you can build. Whereas if you're a rural resident, we have to follow our it's $205 a square foot is the maximum you can build for as a rural resident customer, or the appraised value would need to be less than 392,000. So that's really the biggest stipulation we have when it comes to those two. But if you're a part-time farmer, you could be on 2 acres, but you generate $500 ag income. You can build that home for as large as you want.
Okay.
Hopefully, I answered that accurately.
Yeah, I'm in the banking world, and even for me, my head kind of went like this.
Yeah, I know.
So what I would tell you guys, if you guys are thinking that Ben's the right fit for you, I would just spend time with him and make sure that you identify, like, give him your information. It's kind of like qualifying for the loan. Give him your information, let him run through and say yay or nay, so that you can know right up front kind of what it looks like. So jumping down to myself, I'm probably towards the opposite end of the spectrum. So I'm good with lots in the city, on the lakes. We can certainly do rural. I can go up to larger acreage, 40, 50, 60 acres. That once we start getting into like the actual farms, like if you're going to try to build on a working farm, that's where we start moving you to Ben, because that's their element. So if you've got a beautiful piece of rural property sitting on 40 acres, that's just, maybe you're going to hunt out back or whatever, we can do that. So I don't really have a minimum or a maximum. It's just kind of using some guidelines of where we were at on our terms. Okay. Let's see, kind of moving into the next. How about timing? So I get a lot of customers coming to me right now talking about, hey, John, I want to build my house and then sell my current place. Ben, are you seeing that? And if you so, kind of what's your conversation look like with customers that are in that position from a timing issue?
Yeah, that is one of the biggest juggling acts, if you will, because we'll get customers that want to build their home, yet they have a current home mortgage and they may need to live in that before they can move into the new. So in that situation, and we have two options. One would be, maybe you're going to simultaneously sell that home that you're in and you could move in with friends or family until the new one's built. So we could exclude that from debt to income ratio. And as far as qualifying you goes, if that's not an option, we may look to take both as collateral, because we don't do what's called a bridge loan. We don't allow for excluding that without actually selling it prior to close. So we would require it to sell prior to close if we're going to look to exclude it from your debt to income ratio. That is your current home mortgage that you have. The way around it, if your income could support it, we take both as collateral, which could potentially mitigate your total down payment and maybe even closing costs, depending on how much equity is there. As far as timing goes, our loan process takes 30 to 45 days to close. If we have you apply, a pre-qualification is good for 90 days. That's as long as your credit score is valid for. So you kind of want to time it up to when you want to break ground and when you'd want to apply. So let's call it August 1st because that's on Monday, and 90 days is as long as your pre-qualification is valid for. Let's see. If you wanted to break ground November 1st, you would likely need to apply around mid-August in order to be within that 90 days. And that's pushing it a little bit slim there. But generally, I tell people to apply, I don't know, just think about it in that 90-day time frame to make sure you're within that, essentially.
So, and how long does it take you to get a loan closed typically? So if somebody's ready to go and they're ready to go
Yeah.
today, what do you tell customers as far as how long the process actually takes before you get to closing?
So once we have all their financial information as well as their construction information, I call that day one. We would order title work and appraisal, submit the loan to our credit department for approval. That's day one. It takes 30 to 45 days on average. Appraisals take 2 to 3 weeks on average. So right off the bat, you're looking at 14 to 21 days out of that 30 to 45 day time frame. And then it just depends on how many loans we have in our processing queue. And that generally eats up the majority of the rest of the time, as well as coordinating a closing date with the title company, because a lot of times their schedules are backlogged a bit. It just depends. So 30 to 45 days on average.
Yep. That's a good point, because title companies have gotten backed up. So guys, just know that if you're working with either one of us, there are some things that fall out of our control that you could get down to the end and say, hey, we're ready to close. And the title company could be a week or 2 weeks out even. So it's looking a little better right now, but last year that was a huge problem. Some of the title companies were out 8 weeks. So right now, I think we've gotten more back to center in normal on that. So on our side, just as an FYI, we do bridge loans. Where the bridge loan basically is a loan that's going to pay off your existing mortgage, extract any equity that you have out of your current house. That's going to be used as your down payment on the construction loan. To Ben's point, however, you do have to still be able to qualify for that new bridge loan payment, as well as all your other debt and the new mortgage payment. So, but it is a great tool. I've used it a lot, and really provides some flexibility. The nice thing about it too is that the bridge loan is interest only, so that helps with affordability and qualifying, because it knocks those payments way down because it is interest only. So timing wise, as far as actual closing, same thing as Ben's talking about. We run about 30 to 45 days on construction loans. So I think that appears to be kind of in the norm. So Ben, we're starting to come up on 11:45. I do want to hit on the one question people always hit on a lot: interest rates and closing costs. So I'm going to give a quick disclaimer. Ben and I cannot quote specific rates, because then we have to get into compliance issues with APRs and all this other, legal jargon. So what we're going to talk about is more of a range and direction and trajectory of interest rates than in closing cost, because in Ben's situation, I'm sure it's going to be just like mine. Everybody has a different situation. I could have two people walk in the room with different credit scores, down payment, type of house they're building, and have it go in two different directions. So Ben, just roughly, can you give some kind of ranges of, if we just assume some of the best rates for high credit scores and good loan to values, what kind of ranges are you looking like? And then also with closing costs, just rough.
Yeah, I'll tell you. So again, it reverts back to what customer segment you qualify in at Greenstone. Whether you're a rural resident customer generating no ag income, you're on less than 10 acres, or if you're a part-time farm customer, you have that agricultural income of $500 annually, or you own 10 acres or more, that'll dictate your interest rate. 700 credit score or better will qualify you for the lowest interest rates with Greenstone. And with a rural resident, the rates are going to be, let me just verify today, because I'm pulling up ours today. Yeah. So for a rural resident, they run about a quarter of 1% less than our part-time farm customers. So if you have a 1% for a part-time farm customer, the rural resident's going to run at 0.75%. So it's a 0.25% difference between the two. The reason being, as a part-time farmer with us, the options for building, there's really no limit to them, and the flexibility is much greater, as well as on 10 acres or more, there's fewer lenders that can do the type of financing that we're doing. So it's more of a risk, I guess, is the way it's perceived.
Right.
But did you say you wanted me to give a general range?
Yeah, just so that people can kind of see the market. I actually, while Ben's showing that, you guys, I'm going to do something for you here. I'm going to actually show you a screen so you can get kind of a feel of what the market looks like. So hopefully you can see this. This is actually mortgage-backed security pricing for today. So these are bond prices, not interest rates. So they're inverted, okay? Meaning as prices on bonds go up, rates come down. So you can see where, back here in May, that's where we took that big jump off the cliff and rates skyrocketed. They've been making their way back up. We've had some nice rallies, you guys. So rates change on a daily basis, just like the stock market. So what Ben's throwing out there, that's why we can't quote rates. He's just giving you some ranges. You can see we're starting to make a little bit of a nice recovery. That could change tomorrow though in a heartbeat, you guys. So know that, you've got fluctuation inside of there. So that's important just to consider. Okay. All right.
I will just say, so if we're going to go with our part-time farm category customer, which I said those rates are a bit higher, but the flexibility is much more available. And there's some other key perks there that I would speak to a specific customer on. It's a little bit too lengthy today. But today, I mean, you're looking at, if you go to a 30-year fix, it's the largest amortization we can do. You're looking anywhere between 6 and 7%, that is. And then as a rural resident, it's about generally around 0.25% less than. Again, that's variable on your credit score as well as day to day, because interest rates do change daily.
Yeah, perfect. And so, guys, I'm just trying to point out. So, when Greenstone's doing stuff, they're doing things that a lot of other people can't. So, if you go to them and that rate seems a little bit higher than the market, well, because they're doing things other people simply will not do. It's a risk factor. Okay, they're not trying to be predatory or gouge you. They're trying to fill a place in the marketplace, fill a need in the marketplace based upon overall risk. Okay. So with us, you're going to see our rates be a little bit better than that. We're down into the mid 5s, but we have, we're not going to, you got to have a licensed builder. Ben can let you do this on your own. So there's different risk factors that fall inside of those categories. So keep that in consideration, and knowing also that those rates change on a daily basis. Okay. Hey, Ben, I did forget, just because I do have some folks that are looking at like barn-dos as second homes. Are you primary residence only? Is it just primary?
We do secondary residence as well, specifically for part-time farmers. If you're a rural resident customer, it would have to be intended as, well, no, disregard that. We can do secondary residences.
Okay, perfect. Yep. Because that's a big deal, you guys, because second home financing made some huge changes back in January and February. A lot of lenders now are they're hitting people hard for secondary financing costs and or rates. So I actually am not only a specialist in construction and barn-door financing, but I am actually a specialist in second home vacation properties. So you get the best of both worlds on my end too, if you're deciding to build that dream lake house or something that is going to be considered a second home for you. I did Ben, we got a question that jumped in here, and we're running up on the end of this. Yeah. So this is from Nicole. She's coming back and asking about the contractor requirements. Can we be our own GC? So Nicole, I'm going to answer real quick. This is going to be recorded. So everybody on this, I'm going to record this. I'm going to post it on my Facebook page. We'll get Ben to share it and stuff, so that if you're talking to either one of us, we'll have access. But Nicole, you with Greenstone, Dart Bank requires you to have a licensed general contractor to oversee the whole project. With Ben, you can be your own general contractor, but he's going to have specific requirements. We talked in detail earlier on in the beginning, but feel free to go back to the first part of the recording, or call Ben direct about the GC. Yep. Let's see, as we're getting wrapped up here. Boy, there's actually still a lot to cover, you guys. We may have to do version 2 of this, all right? Yeah. Here's what I would tell you for today, that we did actually cover quite a bit of ground. I'd certainly like to talk a little bit more about appraised values, is probably where every lender has seen the biggest issue, in construction financing over the last year. So maybe that might be a specific topic we hop onto. But here's what I would tell you. If you're trying to get more information, go on my website. We've got a YouTube channel. Follow us on Facebook. Subscribe, because I'm throwing out all kinds of information on this. Like Ben alluded to in the beginning, I also put out stuff that's weekly market updates. Gives you kind of everything about recession. I've been doing this for 30 years, you guys. I put my finger on a lot of stuff, so I can call some things pretty accurately and help people with the directions that they're heading in. But we cover directions of interest rates. We cover the real estate market and pricing. I've seen a lot of the garbage out there about the housing crash. Ben nailed it in the very beginning. We're not going to have the 2008 crash that people are talking about. We are in a recession, And I don't know how deep it's going to get, but we are in a recession. So that is coming. I mean, we're here. The government will tell us that it's coming. I guess they're just, maybe they need to read the newspapers and not social media. I don't know. They're just behind. But subscribe to our YouTube channel, follow us on Facebook, go to my Michael Mortgage website, and you can watch stuff on there as well. If you are ready to deep dive into your own stuff, there's nothing better than reaching out to a lender direct, sharing your information, filling out an application that you can do online with us or with Ben. Ben, by the way, how do people follow? Is the best to call you? Do you have an online app? What's the best way to if they're ready to deep dive?
Yeah, so greenstonefcs.com. That has all of our information on home financing and also home sites. Home sites that, you buying the land, maybe you want to buy the land first before you build, but it has all the frequently asked questions as well as our, general guidelines there. That is my cell phone number that John listed there. That is a good way to contact me. I can get you in the right hands if I'm not the specific loan officer for maybe the part of Michigan that you're looking to build in. But yeah, greenstonefcs.com will get you right where you need to go. You can apply from there. You can also search Greenstone location closest to you from that website as well. And I did want to add in as well, with Greenstone's rates may being a little bit higher. Greenstone is member owned. We're a cooperative. So part of your benefit of being a cooperative is that we give back a portion of the interest that you pay every year. And so when you factor that in, and I can explain that in more detail, we get really competitive on rate once you factor that in too. So I just wanted to throw that out there as well.
Yep. Great point, Ben. So, that is, guys, is one more to kind of wrap it up. Another great reason why to really, when you are ready, reach out direct to your lender and really spend time with them individually, because there's one thing that I've been preaching throughout the entire year, and you'll see this inside of my videos. If you follow me on Facebook or YouTube or anything, or you're going to hear me say this word, and everything today is relative. Everything's relative. The decisions you make, the position you're in. And so, social media and everything is great for information, getting general stuff. But once you're ready, really get into, to following the specifics, because the information you hear from family, friends, while they're posting online, they have very good intentions. And I see it. I know it. I know what's good in their heart, and they mean well. But there are so many variables that the slightest factor could, for a particular situation, could turn somebody immediately. You heard Ben, talking about some of the specifics that he has, whether or not you're, a part-time farmer. That could be something that that you have that your uncle didn't when he applied to Greenstone, and you could benefit from that. Okay.
Exactly. So everything is relative.
Yep. So everything's relative. So, hey, when you're ready, check us out. Ben Hawes with Greenstone Financial, John Michael and Michael Mortgage Planning at Dart Bank. We love doing this stuff for you guys. Stay tuned. Subscribe to the YouTube channel if you want more information, or join us on Facebook. Otherwise, have a great Friday. Enjoy your weekend.
Thanks, everybody. Have a great weekend. greenstonefcs.com.